All right, let's jump right into this explainer and unlock what is honestly the master key for your CMA exam, cost accounting standards. Whether you're just trying to navigate the complexities of your syllabus right now, or you're gearing up to step into a future corporate practice, mastering these principles isn't just about passing a test. It's really about learning the actual language of cost management in the manufacturing and service industries.
Here is your quick roadmap for today. We're going to hit the need for standards, enter the CASB, the core objectives of the CAS, an overview of the 24 standards, and finally, legal frameworks and compliance.
Section 1. The need for standards, or as I like to think of it, moving from total chaos to reliable consistency.
I want you to imagine the absolute chaos of inconsistent cost measurement across different manufacturing and service sectors. Seriously, if Company A measures the cost of its materials using one specific method and Company B uses a completely different, undocumented method, how could regulators, investors, or even internal management ever compare apples to apples? Without a structured approach, historical costs are literally just random numbers. The economy desperately needed a unified framework just to bring some order to the madness.
So what are they really? Well, a structured approach was required to guide everyone, from user organizations and government bodies down to regulators and academic institutions. These standards mandate absolute uniformity and consistency in exactly how costs are classified, measured, and then assigned to various products and services.
Moving right along to Section 2. Enter the CASB, the actual architects of all this standardization.
Recognizing this critical need for a structured approach, the Institute of Cost Accountants of India stepped up. They established the Cost Accounting Standards Board, or CASB for short. Their prime directive? To formulate and harmonize cost accounting principles, all while making sure to consider applicable laws, the local business environment, and even international practices. Now, the primary functions of the CASB actually cover a ton of ground. First off, they issue the frameworks themselves and equip professionals with better guidelines. They also assist members in preparing uniform cost statements under various statutes. But they don't stop there. They provide ongoing interpretations, they issue application guidance, propagate adoption, educate users on why this all matters, and, this is a big one, they actively persuade government authorities to enforce these standards across industries.
Section 3. The core objectives of CAS. Basically, why do these standards actually matter?
The board operates with 6 very specific objectives to drive value. First, they aim to develop high-quality standards. Second, these standards enable management to make genuinely informed decisions. Third, they allow regulators to function so much more effectively. And they achieve all of this through the final 3 steps, by integrating, harmonizing, and standardizing cost accounting principles and practices completely across the board. Okay, Section 4, the 24 Standards Overview. Consider this your literal blueprint to the CAS. Yep, 24. There are exactly 24 officially released cost accounting standards that you absolutely need to be aware of for your exams.
Now, the complete list covers a massive range of topics. We're talking everything from CAS 2 on capacity determination, all the way to CAS 14 on pollution control cost, and CAS 24 on treatment of revenue in cost statements. Trying to memorize every single detail of all 24 right this exact second? Yeah, that might be a little overwhelming. So let's narrow our focus a bit.
Just to give you a sense of the sheer breadth of what they cover, look at these examples. You've got totally foundational elements like CAS 1 for classification and CAS 6 for material cost. But then it goes all the way into highly specific operational areas like CAS 14 for pollution control and CAS 18 for research and development. They truly leave no stone unturned in the manufacturing and service sectors.
Finally, Section 5, Legal Frameworks and Compliance.
Listen, this is a crucial hierarchy you have to understand. While the CASB creates these incredibly comprehensive standards, the law remains supreme. If there is ever a subsequent change in the law that makes a standard inconsistent in any way, the provisions of the law will automatically prevail over the cost accounting standard, every single time.
And remember, the CASB doesn't just write these rules up and walk away. A massive part of their function is actually advocacy. They actively work to persuade the government and appropriate authorities to actually enforce these standards out in the real world. They want to facilitate widespread corporate adoption and educate users on exactly why compliance is so critical.
So,
As we wrap up this explainer, I want you to remember that the CASB isn't just about creating boring rules. It's about creating a shared financial language. By harmonizing exactly how we classify and measure costs, these 24 standards empower management to make truly informed, strategic decisions. When you sit down to prep for your exams, ask yourself, are you just memorizing a textbook, or are you actually learning how to translate financial chaos into actionable corporate strategy?
Today, we're going to build a rock-solid mental framework for two absolutely crucial, highly testable cost accounting standards. If you're gearing up for your CMA exams, you already know how critical it is to completely master the standards that dictate how costs are classified and how capacity is determined. We're going to break these down today so you can easily pull them from memory on test day.
So think about this for a second. Have you ever wondered how completely different organizations, or even just different departments within the exact same company, can compare their costs fairly? Well, the secret lies in standardizing the rules of the game. Because without a universal set of rules, analyzing financial performance is basically like comparing apples to oranges.
Here's our quick agenda for today's explainer. 1. Intro to cost standards. 2. CAS 1. Cost classification. 3. CAS 2. Capacity determination. 4. Understanding capacity levels. And 5. Idle and excess capacity.
Starting off with Section 1, Intro to Cost Standards, setting the baseline. So, why do we even have these rules? Well, the fundamental purpose of the Cost Accounting Standards Board is to integrate, harmonize, and standardize cost accounting principles. And this applies to all cost statements that require classification and disclosure, especially those that need formal attestation. By making these methods standard across the board, management and regulators can actually trust the data and make reliable, comparable decisions.
Moving right along to Section 2, CAS 1, Cost Classification.
The absolute primary goal of CAS 1 is pure uniformity and consistency. When you're presenting costs and cost statements, they have to be classified the exact same way period to period. Actually, you can't even change how you classify them unless a law or a compliance update to a standard literally forces you to. And if you do make a material change, you have to fully disclose it in those statements. It's all about maximum transparency here.
When you're staring at a massive, chaotic list of costs on the exam, you need your brain to instantly snap into sorting mode. Picture a logical, structured hierarchy. Every single cost item has to find its proper home to ensure full transparency and consistency throughout the reporting cycle.
Okay, grab a mental highlighter for this one. You've got to memorize these 5 specific principles of classification. We've got classification by nature, like material, employee, or other expenses. By traceability, meaning is it direct or indirect? By function, things like production, administration, selling, distribution, and R&D. Then there's by behavior, which covers your fixed, variable, and semi-variable costs. And finally, by production process, like batch, process, operation, contract, or joint costs. Locking these buckets in is going to save you so much precious time on those multiple choice questions.
Now for Section 3, CAS 2, Capacity Determination. The standard lays it out super clearly. Capacity has to be determined in terms of units of production, services, or equivalent machine or man-hours. Why does this actually matter? Well, because assigning your overhead depends completely on your assumed activity level. You need a rock-solid, uniform method to figure out costs accurately across the entire operation.
Which perfectly tees up Section 4, Understanding Capacity Levels.
Now, installed capacity, that's basically a fantasy. Think of it as your theoretical, perfect world maximum. It's usually based on the technical specs of the facility, a formal technical evaluation, or the operational limits of your most critical machines. But here's the catch. It completely ignores any allowance for delays. So while it's essential for engineering, it is totally impractical for determining your actual overhead rates.
But then, practical capacity brings us crashing back down to earth. This is the highest achievable capacity once we admit that, hey, minor, unavoidable interruptions are always going to happen. And we're talking about internal factors here, not external issues like a sudden drop in customer orders, but the everyday, nitty-gritty realities of running a facility.
Let's walk through the math. You start with that pie-in-the-sky installed capacity, right? Then you deduct the inevitable disruptions. You need to know these specific adjustments for the exam. Time lost for scheduled, preventative, or planned maintenance, normal shutdown days, holidays, normal idle time, and normal time lost in batch changeovers.
Just to put it in perspective, standard unavoidable disruptions usually eat up roughly 15 to 25% of your maximum capacity. Next up, normal capacity. This one smooths out all the bumps. It looks at the big picture, factoring in the reduction in capacity from long-term trends and planned maintenance over a cycle of years. Basically, it represents an average, achievable volume under normal circumstances, totally filtering out the noise of short-term cyclical fluctuations.
And then, of course, we have what actually happened, actual capacity utilization. When the exam asks you about actual utilization, remember it's measured by the volume of production achieved, but it's generally expressed as a straight-up percentage of your original installed maximum capacity.
Finally, Section 5, Idle and Excess Capacity.
Idle capacity is kind of your umbrella term for unused resources when a system is running below its full potential. It's simply your installed capacity minus your actual capacity utilization. But don't expect the exam to stop there. They are absolutely going to make you categorize this unused potential further.
You absolutely need to lock this side-by-side comparison into your brain right now. A huge trap for test takers is mixing up normal idle capacity with abnormal idle capacity. Normal idle capacity is just installed capacity minus normal capacity. It's totally expected. Abnormal idle capacity, on the other hand, is normal capacity minus actual capacity utilization. This hits when your actual capacity unexpectedly drops below what's considered normal.
And get this, yes, it is actually mathematically possible to beat your installed capacity specs. CAS2 literally defines this positive variance. If your actual capacity utilization is somehow greater than your installed capacity, boom, that difference is your excess capacity utilization.
I want to leave you with a provocative thought as your homework. It challenges you to take these capacity definitions and synthesize them directly into your overhead variance calculations. Think about it. A sudden lack of customer orders is an external factor, right? And that leads to abnormal idle capacity. So how does your organization account for that underabsorbed fixed overhead? Does it get charged off directly to the costing profit and loss account? I'll let you dive back into your study materials to confirm that one.
Look, if you're gearing up for the CMA exam, cost accounting standards can honestly feel like this dense, impossible maze of rules and regulations. But don't worry, today we're going to clear that path together. We're stripping away all the fluff from CAS3 and CAS4, locking down the exact blueprints the Institute expects you to know, and getting you totally ready to ace this exam. Let's get into it. So, here's our game plan. We'll kick things off with the foundational role of CAS. Decode production overheads in CAS3, talk capacity levels, break down captive consumption in CAS4, and finally wrap up with your absolute must-know exam takeaways. All right, part 1, the role of CAS. Before we start memorizing a bunch of intricate rules, we really need to ask the obvious question. Why do these standards even exist in the first place? Well, CAS isn't just some boring academic theory. It exists to bring structured uniformity and consistency to cost determination, making sure things are reasonably accurate across the board. It promotes transparency for the folks making the big decisions. And honestly, it fulfills strict regulatory mandates, like Section 209(1)(d) of the Companies Act, where the government actually requires standardized cost accounting practices for certain industries. Think about it like this. In cost accounting, your direct costs, like direct materials and direct labor, they cleanly separate themselves from the rest of the pack. But the indirect stuff, the indirect materials, indirect labor, and indirect expenses, they operate a little differently. They basically all get funneled straight into this giant bucket labeled overheads. And it's exactly this bucket that we need to figure out how to handle. Which brings us nicely to part 2, decoding CAS3. This is the standard that governs production and operation overheads. And definitely jot this down for the exam. It became effective on April 1, 2016. Now, before we start assigning any of these costs, we've got to know what gets thrown out. Take the term abnormal cost. This is any unusual, atypical, or irregular cost that pops up from some unexpected situation. CAS 30 explicitly tells us that abnormal costs, along with things like imputed costs, fines, and penalties, never ever form part of your production overheads. They are strictly excluded. So how do we actually assign the overheads that do make the cut? Well, CAS 3 gives us two main routes, assuming they're traceable in an economically feasible way. First, there's cause and effect. This is where you can directly link the activity to the cost. The second route is benefits received. That's where you apportion overheads proportionally, based entirely on the benefits a specific cost object actually gets. When it comes to presentations and disclosures, don't try to memorize whole paragraphs. Just anchor these key ideas in your mind. Overheads have to be presented as a separate cost head. They need to be detailed element-wise and behavior-wise, and you have to reconcile any under- or over-absorption. Also, if something significantly impacts that final number, I'm talking foreign exchange transactions, subsidies, abnormal costs, or changes in accounting principles, you absolutely must disclose it. Moving on to part 3, capacity levels and absorption rates. Because let's face it, overheads don't just exist in a vacuum, they're entirely tied to how much the plant is actually doing. Capacity basically steps down from a theoretical dream to reality. Step 1 is installed capacity. That's your plant running perfectly, 0 delays, which, let's be real, is never going to happen. So you deduct unavoidable disruptions and you drop down to practical capacity. Finally, you factor in planned maintenance and normal breaks, and you arrive at normal capacity. And that normal capacity right there, that is our hero metric for exam calculations. And here is the absolute ironclad rule for absorption rates under CAS 3. Variable production overheads, the ones that fluctuate with volume, those must be absorbed based on actual production. But fixed production overheads, those have to be absorbed based on the normal capacity of the plant that we just talked about. If you mix these two up on exam day, it's definitely going to cost you points. Okay, let's pivot to part 4, decoding CAS 4. Now we're shifting our focus over to the cost of production and captive consumption. So what exactly is captive consumption? Simply put, it happens when a company manufactures a product, but instead of selling it to an outside customer, they use it internally for another phase of their own operations. Because there's no open market sale, there's no standard invoice price to tell you what it's worth. That's exactly where CSA 4 steps in, to ensure absolute uniformity in how that internal cost is calculated. Now, context is absolutely everything here. Under the old 2000 central excise rules, captive consumption was heavily monitored. But when the GST rolled out on July 1, 2017, things changed. The concept of captive consumption itself actually stopped being relevant for computing the tax incident. However, and this is a big however, calculating the cost of manufacture remains strictly relevant under GST laws whenever the value of a supply is based on its cost. So under modern GST rules, CAS 4 is basically your master blueprint. You're going to use it to determine the cost of production, the cost of acquisition, the cost of supplying goods, and even the cost of providing services. Crucially, it's also used to determine the value of a supply when you need to match it against an open market value or against goods of a similar kind and quality. All right, part 5, CMA exam key takeaways. Let's bring it all home and bundle these facts tightly so you can effortlessly clinch those points on test day. Think of this as your mental filing cabinet. CAS 3 is your definitive guide for assigning production overheads using either cause and effect or benefits received. CAS 4 is your master key for handling supply valuation and internal costs under the GST framework. And CAS 2, that provides the vital assist, showing you how to step capacity down from installed to practical, right down to normal for your fixed overhead absorption. I'm going to leave you with a quick active recall challenge for your study session. What is the primary objective of cost accounting standards? Sure, it's uniformity and consistency, but think bigger. Without these standardized rules, how could regulators or stakeholders possibly compare the health of two rival manufacturers? Keep digging into the why behind the math, and I promise you, you will absolutely dominate this exam. Keep studying smart, and I'll catch you next time.